So for question 2, they said, Jeff is a manufacturer of motor vehicle. Divide the following terms. First, raw materials. When we talk about raw materials are resources that are used to finish a product, that makes a product. Whatever we need to produce, we need resources to make them available. So you can say raw materials are resources that is used for finished products.
Mm-hmm.
Do you get what I'm saying there?
Yeah.
Resources that are needed to make finished products. They are raw materials.
Mm-hmm.
Then the second one is work in progress. When we talk about work in progress, work in progress are goods that are partly finished. They are not like you want to produce this pen, but
they're in the middle of
producing it.
The process.
Yeah, the process is about to be done, but it's not yet done. We call it work in progress.
Mm-hmm. Mm-hmm.
Do you understand? So we
I
can say work in progress are goods that are partly finished during the financial year. So at the end of the year, you will get it finished. It will be ready to be used or to be sold.
Mm-hmm.
The process.
Yeah.
Do you understand?
Yeah, I get it.
Okay, they're finished goods. These are goods that are fully completed and ready to be sold.
Mm-hmm.
Finished goods are what? Goods that are fully completed and ready to be sold.
Mm-hmm.
Any questions about that?
No.
Okay, great. Then we go to question 2B. Okay. Oh, okay. Then they said Jeff provided the following information for the year ended 31 December 2019. Remember, Jeff is a manufacturer, or they said he's a manufacturer of vehicles, right?
Yeah.
So this account, what we are seeing here, it's a manufacturing account.
Mm-hmm.
So what's a manufacturing account? A manufacturing account provides information about what the business is, in the cost and the expenses the business is going to incur in the cost of producing a product. That is manufacturing account.
Mm-hmm.
Do you get what I say here?
Yeah, I get it.
The manufacturing account provides information about expenses and costs incurred by the business in the cost of producing a product.
Mm-hmm.
You know, when you produce the product, you are about to sell the product, right?
Yeah.
Yes. So that's what a manufacturing account is. So with this information we have additional information. So we have inventory for January. So for the January one, that's the opening inventory for finished goods, opening inventory for raw materials, opening inventory for work in progress. December 31, these are the closing.
Mm-hmm.
All right. So then we have other items, factory machinery, we have factory machinery, the cost of it, the provision for depreciation. We have our carriage inward, we have insurance. These are all expenses of the business.
Mm-hmm.
All right. So
yes.
With this additional information, they said insurance, its lights and power are apportioned between the factory and the office in the ratio of 80-20. So each light and power paid in advance is 1,750. So, okay, let's start with this way. So based on this information, the first thing we have to open is a manufacturing account. You write manufacturing account for the year ended 31 December 2019. So as soon as that is done, the first information is the opening inventory of raw materials, because without raw materials, you cannot provide the products. Yes or no?
Mm-hmm.
All right. So the first information is opening inventory of raw materials, which is 18,750. Are you there?
Yes.
So you write opening inventory of raw materials, which is 18,750. Then you add purchases of raw materials. We have purchases here. These purchases, yes. You add it. Add purchases of raw materials, 238,795. Then we check what we have again. We have carriage inwards. You know what carriage is now? The amount of money you spend to ensure that the product delivered, the raw materials are delivered to your premises. It's still part of your cost.
Mm-hmm.
So you add carriage inwards. So that will give you 18,750 plus 238,795 plus 8,955.
266,500.
Great. So that's 260,500. Then you less your closing stock of raw materials, which is 16,250 minus 16,250. So we have 250,250.
Huh? Can you repeat it, Mister?
We have 266,500, right?
Yeah.
Then you less your closing stock, closing inventory of raw materials, the closing stock of raw materials, 16,250. You less it.
Yeah.
You take it away from 266,500.
That's it.
Yeah, you less it. You take it away.
Yeah, you just less it by 16,250.
Then you have what we call the cost of raw materials consumed. So the figure you get is called the cost of raw materials consumed. Is it clear?
Yes.
So that's the cost of raw material consumed is 250,250.
Yeah.
All right. Now we go on to direct expenses. We have our direct expenses here, royalties. Another name for direct expenses is royalties. You see royalties, right?
What does it mean?
Royalties or direct expenses.
So direct expenses is royalties.
Yeah, that's 50,000. Then we have wages, direct wages. Do we have direct wages? Okay, let's check. Hold on, please.
8.
Production wages. We have wages for owing, supervisors' wages, production wages for workers owing. So we had them together there. 1,250. We have production wages, 98,000. Production wages is 98,000. Can you see that?
Yeah.
But they are owing the workers. Production wages for workers owing 1,250. Then you add it with 98,000. So your direct wages will be 98,000 plus 1,250.
98,000 plus
1,250 from the additional information.
1,250.
So we have 99,250. Right?
Yes.
So cost of raw materials consumed plus direct expenses, which is the royalties, plus direct wages, gives you your prime cost. So that gives us our prime cost. So cost of raw materials minus the direct expenses, you have your prime cost, which is 399,500. Is that clear?
99,500.
399. 399,500. 399,500.
399,500. Yes.
Okay. Now they said, so for the factory machinery, we have 20% of depreciation, right? Look at here. They said 20% of depreciation per annum, right? So for factory machinery, the value for factory machinery is how much? Let's see. %. Factory machinery is charged at 20%. Yeah, factory machinery is 90. The cost is 90,000. Do you see that? Then we have the provision for depreciation to be 43,920. Hold on, please. 920. 20%. Cost, okay, 90,000 minus 43,000. That's our NPV, 43,920 times 20 divided by 100. Yeah. All right, are you there with me?
Yeah.
All right. So depreciation on factory machinery. How do we get that? The cost of factory machinery is 90,000. So 90,000 minus the provision for depreciation, 43,920. That gives us, we have 90,000 minus 43,920. That's 46,080. Yeah, we have 90,000 here. I highlighted it already. 90,000 and this.
Yeah. 46,180. 080.
Okay. It gives you what? 46,080. And we're told that the factory machinery is charged at 20% per annum using the reducing balance method. For the reducing balance method, what we do is 46,080 multiplied by 20 over 100. Multiplied by 20 divided by 100. So we have 9,216.
9,216.
So that's the value for depreciation on factory machinery. You add it with your prime cost.
Prime cost.
Yeah, don't worry, just continue with me. Just listen, don't worry, I have the information here.
Yeah.
Okay. Then they said insurance, heat, light, and power are apportioned between the factory and the office in the ratio of 80-20. So we have insurance. They said insurance is 12,500. Are you there with me?
Yeah.
But here they said insurance, heat, light, and power are apportioned between the factory and the office in the ratio of 80-20. So heat, light, and power paid in advance. Okay, we don't need that. So yeah, it said 80 ratio 80 and 20. So we check 80-20, 12,500. 12,500. 12,500. Insurance is 80 ratio 20, that's 80. Times 80. We have 12,500 multiplied by 80 divided by 100. That's 10,000. So for insurance, based on the additional information, are you with me, please?
Yes.
Based on the additional information we have, insurance in the item, insurance is 12,500, right? Insurance is 12,500. Okay, can you see it there? Here, 12,500, that's insurance. All right.
Yeah, I see it.
Yeah, but they said insurance, heat, light, and power are apportioned between the factory and the office in the ratio of 80-20. So what does that mean? It implies that 12,500, the total 80 plus 20 is 100, right? So if 80 plus 20 is 100, 80 goes for insurance, 20 goes for heat, light, and power. So we're going to have 12,500 multiplied by insurance 80 divided by 100. Do you get what I did now?
Can you repeat it?
I will. They said insurance is 12,500. Heat, light, and power is 37,250. But in the additional information, they said insurance, heat, light, and power are apportioned between the factory and the office in the ratio of 80-20. So that means 80 for insurance, 20 for heat, light, and power. So how do we calculate this? We calculate it this way: 12,500, which is the cost for insurance here, expenses for insurance, multiplied by 80, which is the ratio for insurance, divided by 100, because 80 plus 20 is 100. So that's, we calculate it together, please. We have 12,500 multiplied by 80, that's 1 million. So 1 million divided by 100, 10,000. So that's how our insurance is 10,000. So the value for insurance will be 10,000. Okay?
Yes.
I have it here and I made the analysis here. So just listen.
I'm listening.
All right, great. Then the next one we have is supervisor wages. Supervisor wages is 20,575, right? But there is the one owing. So we have 28,000
575
plus additional information 2,325. That's 30,900. So it is, so supervisor wages is 28,575 plus the one owing and in the additional information 2,325. That gives us 30,900. Is it clear? All right.
Yes.
Then the next thing we have is heat, light, and power. For heat, light, and power, the total is 37,250, right? This is here. 37,250. Can you find it?
Yeah.
Hold on, please. Okay. So for the supervisor wages, for heat, light, and power, we have 37,250. Then the ratio is multiplied by 20 divided by 100. Can you get that? 37,250 multiplied by 20 divided by 100. So let's calculate. That's 7,020 multiplied by 20. That's 745,000 divided by 100. 7,450. Is that clear?
Yes, it says.
Yeah. Then, what else do we have? Now we had our opening inventory. Opening inventory of work in progress, 21,570. You add it to it. Opening inventory of work in progress, 21,570. Then you less the closing inventory of work in progress, which is 18,590. So when you less it from it, your total will be your cost of production. So 478,016 minus plus 21,570, which is the opening inventory of work in progress, minus 18,590, the closing inventory of work in progress, gives you a total of 480,996, which is our cost of production. That's about the manufacturing account. Ibisan.
Yeah.
Okay, I'm back here.
Okay, good.
So like I told you, the manufacturing account, don't worry, you're just going to try your best. Try to place the information I've given to you. I think I've explained as much as I can. So just try to figure out those items. That's all. Then we'll go to question C. Yeah, they said state indicating with a tick which item will be shown in the statements of financial position. So all these items we have here are mostly in the statement of financial position. But where do we post them in the statement of financial position? That is the question. But before we go into that, I would like to explain each item for you. Okay?
Okay. Okay.
For accumulated depreciation is the total amount of assets that can be depreciated on. Now, let's say you have a machine. Let's say you have a machine now, right?
Yeah.
Let's say you have a machine. The total amount going to depreciate over a period of time is what we call accumulated depreciation. So you put this here, as time goes on, it continues to depreciate. The value of the amount of money, the amount in which it has depreciated over a period of time is called accumulated depreciation. Do you understand what accumulated depreciation is now?
Yeah.
the total amount an asset has depreciated over a period of time. The total amount an asset has depreciated over a period of time. That's accumulated depreciation. Okay, so we call it accumulated depreciation. It's because it's for an asset, right?
Yeah.
Assets that are going to depreciate over a period of time are already on the non-current assets, because I told you non-current assets are assets that can stay in the business for more than a year. So accumulated depreciation will be recorded in your non-current assets. Is it clear?
Yes, it is.
So the first one is non-current assets. So non-current assets is accumulated depreciation. You record it there.
Okay.
And we have the bank loan. For a bank loan, we're talking about a credit facility from the bank for over a long period of time. And they said bank loans to 2026, from 2019 to 2026. That's a long term. So it's the non-current liability. So it's going to be ticked in the non-current liability here. Hold on, please. Let me just see if I can use the. Okay. For accumulated depreciation, is a non-current asset. For bank loans, it's a non-current liability because it's going to be for more than a year. That's almost 2019 to 2026. That's over 5 years, I think. I think that's 7 years. Then for work in progress, we said work in progress are the products the business is partly finished by the business that will finish at the end of the financial year. That means the product is in process, is on process. So it will be considered as an inventory to the business. So it's a current asset. Because as soon as it is done, it becomes an inventory, it becomes a stock. It is work in progress, but as soon as it is produced, as soon as it's completely produced, it becomes a stock. So it is part of current assets. Then we have overdraft. What is a bank overdraft? A bank overdraft is a credit facility that allows a bank customer or a customer to receive or to withdraw more than its available credit balance. Let's assume you have $10,000 in your bank account and you needed $11,000. If the bank allows you to take $11,000, it means that they've given you an overdraft of $1,000. Do you get me or not?
Yeah, I get it.
A bank overdraft is a credit facility that allows a customer to withdraw more than its available balance. You have 500 in your account balance as your credit balance. You are able to withdraw 600. The 100 you are able to withdraw more is your overdraft. It's a bank overdraft. But you have to pay it within a short period of time.
Isn't it a loan?
It's a sort of loan, but a short-term loan.
Yeah.
Do you get it?
Yeah, I get it.
Because you have to pay within a year. So it is what? It's a current liability. Is it clear?
Yeah, it's clear.
All right. Then the next one, other receivables. Remember I told you what receivables are. The sum owed by the customers, the amount of money the customers are owing you as a business. So these are what we call other receivables. So it is also part of an asset of the business. But these amounts should be paid within a short period of time.
So it's a current asset?
Great, it's a current asset. You got that. Then the last one, provision for irrecoverable debts. Irrecoverable debts. When we talk about irrecoverable debts, we're talking about you making provision for those debts that the business is having that might not be returned. Like you have a lot of credit customers. So you are making provision for those customers that might not come back to pay. So it's considered as a current asset.
What? Can you repeat it?
Provision for irrecoverable debts. These
Yeah.
are provision made for accounts receivables that you might not be able to recover. I mean, the debtors of your business that will not come back to pay.
Mm-hmm.
Why is it a current asset? It's a current asset because debtors are always in the current asset. So you have made provision for your debtors. In case they don't come back to pay, you replace it with that amount of money you have provided.
Mm-hmm.
That's why it's also a current asset. Do you get the point here?
Kind of.
Okay, I will explain again. Your
Okay.
debtors are current assets. These are the customers that are owing the business.
Mm-hmm.
So they are supposed to pay the business because they are owing the business. But the business is thinking about the future. Maybe the customers will not come back to pay.
Mm-hmm.
As a result, but the account has to balance. As a result, the business has made provisions for those amounts of money that the customers will not come back to pay.
Uh-huh.
So the provision made is still part of the current assets because it's for the debtors.
Mm-hmm.
Is it clear now?
Yeah, it is.
Debtors are current assets. Provision
Yeah.
for those debtors should be what? Current assets.
Mm-hmm.
Is it clear?
Yeah.
All right. So it is also what? Current assets. Any question about that?
No.
No. Then we move on. Now, I think this is the last question. D. I don't know. Maybe it's D. Okay, yes, that's the last question. D. Here they said, evaluate why it is necessary for a business to account for other receivables and other payables. But before we go into this, what are other payables? Other payables are the amounts owed to the suppliers. The amount you are supposed to pay your suppliers, your credit suppliers. Do you understand what other payables are now?
Mm-hmm.
You know, we have other receivables. The amount your customers are supposed to pay back to you, other receivables. Now, you are owing some suppliers too. The amount you are owing them are called other payables.
So the amount I'm owing is
Your
payables,
suppliers,
other payables.
other payables. The amount your customers are owing you, other receivables.
Okay.
Clear, right?
Mm-hmm.
So the question is saying, evaluate why it is necessary for a business to account for other receivables and other payables. What they are saying here is that we should state the importance of making accounts for other receivables and other payables.
Mm-hmm.
So why do we have to do that? First, we have to do it because it is part of accounting concept. It is part of the International Accounting Standards, the IAS, that whatever we do, whatever transactions we do for this year has to go for this year.
Mm-hmm.
So that means whoever we owe for this year, we have to pay them for this year. Whoever is owing us for this year, they have to pay us for this year. So the account for this year ends this year.
Is it like the accrual concept, matching concept?
Yeah, accrual concept. The profit for this year, you must take it away from the expenses of this year.
Mm-hmm.
Is it clear? Is
Yeah.
it clear, girl?
Yeah, it is. It is.
Okay. So here I wrote, one, it is part of the accrual concept. Two, it involves transferring only the amount covered by the accounting period. So because the other receivables are for this year, the other payables are for this year, it means we're going to transfer both accounts into our accounting period.
Mm-hmm.
Then it means that we will be able to compare and contrast the financial year for this year with the financial year of last year. We'll be able to know if we are doing well or not.
Mm-hmm.
And the last one is that if we are able to do this, we will be able to present an accurate figure about our profit and loss, an accurate figure about our assets and liabilities.
Mm-hmm.
Because we have accounted for those that are owing us, and we have accounted for those that we are owing.
Mm-hmm.
Is it clear?
Can you just repeat the last thing you said?
Definitely. The last thing I said is about making accurate presentation about our profit, our losses, our assets, and our liabilities. How are we going to be able to make accurate presentation for these things? We can only make accurate presentation when we are able to analyze, when we are using accrual concept, meaning that the asset, the profit for this year has been in line with the expenses of this year.
Mm-hmm.
Do you get it? So if I am presenting my financial, if as an accountant, if I am presenting the financial statement for this year, I am supposed to give an accurate figure of what has happened for this year.
Mm-hmm.
And to do that, I must not ignore other receivables. I must not ignore other payables.
Mm-hmm.
So that we can give an accurate view of profit and losses, or an accurate view of assets and liabilities.
Mm-hmm.
Is it clear now?
Yes, understood.
All right, so to just take it easy. So we stop here. And
Okay.
I'm wishing you all the best anyway. So hold on, please.
Thank you, Mr.